It is the season to be talking about income taxes. Some definitions. Your gross income is the total amount of income for the year. That's everything that you gain. It's from your wages, it's from tips, it's profits from selling stuff. It's interest that you get on any interest-bearing accounts, dividends from stocks. Now, some gross income is not taxed, such as if you put some of your income away into an IRA. It's still part of your gross income, but it's called an adjustment. Tax-deferred income, like the IRA, means you don't have to pay tax on it when you earn it. You will pay tax on it when you withdraw it. Adjusted gross income is what you get when you take your gross income and you subtract off your adjustments, which is any tax-deferred income. The only tax-deferred income we're going to talk about in this class is IRAs. Once you have figured your adjusted gross income, before you figure your taxes, you have to find what's called your taxable income. So from your adjusted gross income, you're going to take off what we call exemptions and deductions. Now, the exemptions, that's a fixed amount of money per person in your household that you call a dependent. It's $4,050 for this tax year. And like I said, you get a $4,050 deduction, you deduct $4,050 from your income for every person you have in your household that you call a dependent. Deductions, that is either you get a standard deduction for your filing status, a set amount that everybody who's married, filing jointly or single or head of household will deduct, or you have an itemized deduction. Itemized means if you think that you have more deductions than would be covered in the standard deductions that you can prove. And then you can fill out a form where you itemize what all those things are, and you might be able to take more off of your adjusted gross income than the standard deduction would allow. When you take your exemptions and deductions off of your adjusted gross income, you have your taxable income. Taxable income is the income you actually end up paying taxes on. We have right now in our country what's called progressive income tax, and that means people with higher taxable incomes pay a higher tax rate. Notice there's a key word in here, higher taxable income. That doesn't mean that you made more money. That just means that you have more money left after you've taken off your exemptions and deductions. A tax credit comes straight off of your tax bill. A tax credit means you figured out how much income tax you owe, and then you get to subtract a certain amount off for that. There's two kinds of tax credit. One is called a non-refundable tax credit, which means you're not going to get any money sent back to you from the government. The refund is only up to the amount you owe for your taxes. The refundable tax credit means you get that as a refund no matter how much you've already paid in and how much you owe. Now here's where we put some of those definitions into play, because they're not just definitions that you need to remember, they're definitions that you're actually going to have to use to work problems. First one is just going to be to find gross income, adjusted gross income, and taxable income for someone. So Karen is single and earned wages of $34,200 and received $750 in interest. She received $750 in interest. So if I'm trying to find her gross income, I'm trying to find the amount of income that she's received, which is going to be the money that she got in her wages plus interest. Now we're talking about contributions, and that's it. So her income is those two amounts added together, Her gross income is $34,950. Now to find her adjusted gross income, I start with her gross. And if I have any tax deferred IRA kind of things, I can subtract those off. If I didn't have that, her adjusted gross income would just stay the same as her gross income. Since she did contribute to an IRA, I'm going to subtract that $1,200 off. And her adjusted gross income is now $33,750. Her taxable income, you'll have to refer to the charts to be able to understand where the amounts come from. But her adjusted gross income is $33,750. She gets to subtract off $4,050 as her exemption, her personal exemption, and then she gets to subtract off $6,300 for being single, which leaves her with a taxable income of $23,400. Now when we look at Sarah and Marco, we want to actually figure out how much tax they owe. Here's where the definitions really matter. We have to look and see what it is that we're told. We're told their taxable income. If we're already starting with a taxable income, then we're not looking for gross, we're not looking for adjusted gross. All that's been already done for us. So if we start from $87,500, you're just ready to go straight to the tables and compute your tax. Now you're going to have to follow along with the tax table as I do this, so you're not going to understand where these numbers come from. For married filing jointly, if I look in that column and I find what tax rate $87,500 falls into, that would be in the 25% bracket. Now, good news, bad news is they don't pay 25% of the whole $87,500. No. You have to start from the bottom. Everybody who's married filing jointly pays 10% tax on the first $18,550 that they earn. But Sarah and Marco earned more than that. Everybody who's married filing jointly pays 15% of $75,300 of their income. But they don't have to pay tax on the $18,550 twice. So we can subtract off the money that we've already paid taxes on. Now Sarah and Marco made more than $75,300. They didn't make the entire amount that's listed in the 25% bracket. Of the 25% bracket, they only made $87,500. And they still subtract off however much they've already paid taxes on, which at this point is $75,300. Now you can type this entire long line into your calculator, and that's what I advise you to learn how to do. You can do pieces and parts and then add them together, but just as an observation, more people make a mistake if they do it in pieces and parts than if they learn how to type it in. And I know it shouldn't make a difference. Observation alone tells me that it does. When you do this computation, you should end up with $13,417.50. So let's look at Pat. Pat is head of household. with a dependent child and an adjusted gross income of $57,000. He gets a tax credit of $1,000. We want to compute the amount of tax he owes. First of all, you don't go to the tables with adjusted gross income. We need taxable income. To figure out the taxable income, we have to take his adjusted gross income, and we're going to subtract off $4,050 for himself and $4,050 for his dependent child. Now he's head of household, so we also get to subtract off $9,300 for his filing status. His taxable income is $39,600. That is the amount that we take to the tables. So again, we look at the head of household column. This is only going to take us to the 15% bracket. So we start 10% of the first $13,250 plus 15%. Now he didn't have income up to the top of the 15% bracket. He only went up to $39,600 minus $13,250 he already paid taxes on. When I do that, I end up with $5,277.50 is the amount of tax that he owes. But I've got this $1,000 tax credit that comes off his tax bill. So after I've computed his taxes, I get to deduct $1,000 off of that. So he actually only has to pay $4,277.50 in taxes. Now, there's some practice problems for you if you're following along with my notes. You want to make sure you do those, because this is a process that only gets easier to understand as you do it. FICA? FICA must be everybody's best friend because everybody gets to pay FICA. FICA comes straight out of your check. It comes out of only earned income. This money is taken out of your check to pay Social Security and Medicare. You don't get any exemptions or deductions. It's just a straight percentage straight off the top. The amount that you pay, FICA is divided up into a couple of different parts. Social Security is 6.2% and Medicare is 1.45%. And when you add those together, your FICA is 7.65% off your check, straight off the top, no deductions, no exemptions. But notice it says with employer matching. So actually, you pay 7.65% of your income, but so does your employer. So if you add those two together, you're actually paying into Social Security and Medicare 15.3% of your income. If you're self-employed, you're paying 15.3% of your income because you're paying both halves. So we're going to look at an example here where we're going to figure out not only the FICA taxes, but her federal taxes, and then figure out her overall tax rate. So we got Jude, and she earned a total of $26,000 in wages and tips. We want to calculate her FICA tax first. You don't get to adjust that income in any shape, form, or fashion. We're just going to multiply it by 0.0765. And you paid FICA tax of $1,989. Now, the second thing we want to find, when it says marginal taxes, those are her federal income tax. So if we want to find her federal income tax, her gross income is $26,000. Doesn't say she made any payments to an IRA, so we can't take off any deductions or exemptions. We can't do any adjustments. So her adjusted gross income is $26,000, but we do get to subtract off her deductions and exemptions. $40.50 because she is her own exemption. $6,300 for her filing status of single, and that leaves her with a taxable income of $15,650. We take $15,650 to the tax tables, and under the single filing status, she pays 10% of the first $9,275. Plus, she does not top out of the 15% bracket, so it's the rest of her income minus the $92.75 she's already paid taxes on, which means her federal tax bill is $1,883.75. Now that's not actually a question. We wanted to know what is her total tax bill. Her total tax bill is the $19.89 that she got from FICA, the $1883.75 she had to pay for federal, and that totals up to $3872.75. That's her total tax bill. If we want to do her overall tax rate, is going to be a percentage. So we take, this is how much she paid total, divided by how much she made total, and change it to a percent. Her overall tax rate is 14.9%. One kind of income that you can get that's taxed differently is called a capital gains. Capital gains are profits that you make from selling something, usually stocks, bonds, or your house. Short-term capital gains means that you sold whatever it is that we're talking about within 12 months of its purchase. Long-term capital gains means you held on to it for more than a year. Usually doesn't make much difference on which it is unless you're talking about the sale of a house. But now things are taxed a little differently. You will take your capital gains, and when you try to figure up your federal income tax on it, you still get to take deductions and exemptions and do take off any tax deferred investments you made, because for federal income taxes that's still allowed. But once you get down to your taxable income, the way capital gains are taxed is you look at the tax tables and you pay no tax on any of your taxable income that falls in the 10 and 15% brackets. Anything that falls above that line, you only pay 15% on. So let's see how this works. If we want to do the same thing to Serena that we did to Jude, but we see here, her gross income consisted solely of $90,000 in capital gains. Because her income was totally from capital gains, she pays zero in FICA tax. Now that wasn't part of the question, but that's just so you realize FICA only applies to earned income. capital gains, money from profits, do not count as earned income. So all we have to do with Jude is figure out what her federal taxes would be. Well, for federal, she has $90,000 for her gross income. She gets no adjustments, is what it said, but she does get the personal exemption, and she has $12,000 in itemized deductions. If I do all that, her taxable income turns out to be, talking while I'm writing, that would be $79,650. This is her taxable income. Now, if I take that to the tax table, what I said is any income that falls in the 10 and 15% brackets for her filing status, which is single, gets no tax. So if I look at the top of the 15% bracket, she gets $37,650 not taxed. So we can subtract that off. And that leaves her with $42,000 that she has to pay taxes on. But that $42,000 doesn't get taxed in the bracket that it falls in. It gets charged just 15% flat rate. So she pays $6,300 in federal income tax. If we want to find her overall tax rate, well, the only tax she paid is the $6,300. Her income was $90,000. So her overall tax rate, when I do that division and I change it to a decimal, that comes out to be her overall tax rate is 7%.